Welcome back. This is episode 138. In this week's episode, I'm going to talk about what it means to be an accredited investor. And over the last year, I've been hearing a lot about using alternative investments in one's portfolio. So first of all, what is an alternative investment? And that's an investment that's outside of the normal investments you may be using inside of your investment account, such as stocks, mutual funds, bonds, ETFs, and stock options. These are what are known as registered investments. And there are certain requirements that these companies have to go through to register an investment so that investors can do their own due diligence on these investments. And many of these investments that you could consider using have been around for a long time, so there's a lot of information on them, and generally there's not a lot of surprises. However, there are certain alternative investments that are considered non-registered investments that may offer you greater diversification and possibly greater returns than more traditional investment options. And especially when you have a bad year like we did in 2022, where you have a bad year for the stock market and the bond market, you start to see a lot of commercials, at least I have, maybe I'm sensitive to them because of what I do for a living, promoting these investments. I'm seeing these on TV. I'm seeing these on Facebook. I'm seeing these, on other social media. I'm hearing these ads on the radio. And many times these alternative investments that you're hearing about, this could be real estate, this could be from private placements. These are non-registered investments, and they have additional risk than the registered investments that you're probably buying inside of your 401k in your brokerage account. And these non-registered investments are geared more towards sophisticated investors due to their additional risk of loss, their illiquidity, and their additional complexity. Now, the government tries to stop people who may not be suitable from buying these investments from purchasing them. And one way that they do this is by having non-registered investments only be offered to what are known as accredited investors. And an accredited investor is an investor who's entitled to this investment opportunity, and you could say maybe that's a good thing or not, by satisfying at least one requirement regarding their income, net worth, asset size, governance status, or professional experience. And the term accredited investor is used by the Securities and Exchange Commission under what is known as Regulation D. And it refers to these investors who are financially sophisticated. And the SEC feels that therefore there's reduced need to protect these individuals from the additional disclosure filings that would normally be required with a registered investment. And accredited investors can be high net worth individuals. They can be banks, they can be insurance companies, they can be brokers, they can be trusts, and they can even be professionals like myself. And these accredited investors are legally then authorized to purchase these securities that are not registered with regulatory authorities like the SEC. And many of these companies do decide not to register these investments and offer them directly to investors because of the additional cost. You could imagine that registering an investment, there's a lot of cost involved. You probably need to hire certain attorneys and do certain filings, so it really increases the cost of an investment. And these are many times known as a private placement. And they have additional risk, as I mentioned. So authorities want to make sure that people buying them are financially stable, they're experienced, they're knowledgeable about these risky ventures, and if they have a loss, that it's not going to be catastrophic, because having a complete loss of your money in a private placement is very possible. Very rarely, if you're buying high-quality stocks or mutual funds or ETFs, even though there's a lot of risk with those, you're never going to wake up one day and find out that your ETF has gone to zero. But if you invest in a private placement, there's a very strong likelihood that that could happen. Your investment could be completely worthless. So you really need to understand that. And these can be private placements. As I mentioned, These can be venture capital funds. These can be hedge funds, angel investments, real estate, and they involve a lot more complexity and risk. So what are the requirements for accredited investors? So as it's set forth, as I said before, the SEC has Rule 501 of Regulation D. And so to become an accredited investor, a person must have an annual income exceeding $200,000, $300,000 for a joint income for the last 2 years, with the expectation of earning the same or higher income in the current year. And so if you were looking at, you were single and now you're have a joint income, you need to make sure that this is for the last 2 years. You can't combine, they mentioned you can't combine single and joint income. Additionally, you can be considered an accredited investor if you have a net worth exceeding $1 million, and that is excluding your primary residence. So if your net worth excluding your primary residence is $1 million, then you're considered an accredited investor. The SEC also considers a person to be an accredited investor if they're a general partner, executive officer, or a director for the company that is issuing these unregistered securities. And an entity is considered an accredited investor if it's a private business development company or an organization with assets exceeding $5 million. Also, if that entity consists of equity owners who are accredited investors, then the entity itself is an accredited investor. However, they do say that you can't form an organization for the sole purpose of purchasing these securities. So either income or asset-wise, probably for most of my listeners, is going to be how you could qualify as an accredited investor. And there's also been some recent changes. Congress recently modified in August of 2020 the definition to include registered investors, brokers and registered investment advisors. So that does open it up. If I have any listeners who are in the profession, in my profession, but don't meet the income or net worth level, then they can actually be able to invest. So what is the purpose of all this? As I said before, our regulatory bodies have a dual mandate, you could say. One is to promote investments. The other one is to make sure that investors investing in these investments are qualified to own them. So that's hence why they have this Reg D requirement. And I can say from my own experience that I don't currently recommend these. I think for most people, you do better just sticking with the standard investment options. But I have seen some investors purchase them prior to working with me, and usually the results have not been good because, as you can imagine, there's the potential for a lot of fraud or just really, over-promising and under-delivering. So if you are going to get into these, even though you only need a net worth of $1 million, excluding your primary residence to qualify, or income, relatively high income, you're probably not qualified to invest in these. So you really need to make sure that you do a lot of research as much as you can from the limited information that you're going to get. And probably if you're going to do it, put a small amount of your portfolio in this. Almost look at it like you're going to the casino, right? If you normally go to the casino and you take a couple $100s with you, you're okay losing that. You'll sleep at night. Kind of have to look at this investment the same way. If you're putting $50,000 in one of these investments and you're okay knowing that, all right, I know that this money might be gone, then go for it. But if you're not okay with that, then even though there's a promise of these high returns and they promote them on the radio, double-digit returns, a lot of this is really, it's unproven, and it probably won't perform the way they're saying it's going to. You might be better off just sticking with the basics. So I hope this helps answer for anybody that's wondering what is an accredited investor. And as I recommend, continue to do your homework and due diligence on considering any of these investments. And as a reminder, if you have a listener question you want to have considered for an upcoming episode, you can propose that question by going to retirewithryan.com. Have a great week, and I look forward to talking to you next Wednesday. Take care.